Hi everyone, good morning. So today we are going to start with our CFA level 1, chapter 1, quantitative aptitude, quantitative methods. So the chapter 1 is rates and returns, and these are our learning outcomes. So let's start with chapter number 1. So LOS 1A is interpret interest rates as required rate of return, discount rates or opportunity cost, and explain an interest rate as the sum of real risk-free rate and premiums that compensate investors from for bearing distinct type of risk. So before that, let me just give you a quick overview of the time value of money concept. So consider this as a timeline here. Let's assume that you have $100 today and you have an option to receive $100 after 3 years. One, two, and three. At time zero, you have $100, and at time I'm asking you whether you would want $100 today or you will want $100 after 3 years. So it's obvious that you would prefer $100 today, and even though you have the same amount in both the cases, you will prefer $100 today only. And the reason is that if you understand this concept, you will understand this. It means that there has to be some value associated when we talk about time. So because you are putting more value on $100 that you are getting today, that's relative to $100 at a later point of time. And this is actually known as the time value of money. And so $100, the value $100 is providing you at time zero or today is greater than the value it will provide you after 3 years. So you will be able to spend this $100 on your needs, or you are going to invest it. And you know that if you invest this $100 after 3 years, it's not going to be $100 only. So it's going to be more than $100. And here we are offering you only $100 after 3 years. So this doesn't make any sense. So if you are able to figure out this much, you are familiar with the concept of time value of money. Uh, so now let's say that you are indifferent about $100 versus $100 at a later point of time. Let's say that I'm saying the present value is $100, and the future value I'm going to give you future value of $110. And at after 1 year, so at point zero, at point time zero, at time zero and time one, I am giving you an option to have $110. And here, one factor, the important factor is the interest. So interest here is 10%. And this is how in future your $100 invested $100 becomes $110. So if I ask you, you want $100 today, or if I ask you, you want $100 today or $100, $110 after 1 year, so you can prefer anything because this is what the time value of money concept is. So there is going to be present value. So money today, or the value of value today is called the present value, and this could be an investment which you make at time zero. And future value means the value at a future time, a future point in time, and this is called future value. Interest rate is the relationship or the link between these present value and the future value. And this this is calculated using interest rate. And obviously time also. So we will cover the meaning and interpretation of interest rate and learn how to calculate, interpret, and compare different return measurements. So, as per the LOS, interpret interest rates as required rate of return, discount rates, or opportunity cost. So, we have talked about interest rates here. So, this is the main purpose of interest rate, and there is a very wide scope where it's used, and in in multiple ways. So we will talk about the scope now. So I hope this much is clear to you. Okay, so when we talk about interest rate and the time value of money, let's discuss one more example, a different interpretation of interest rate using an example. Say you lend $900 today to somebody and you received $990 after 1 year. Uh, one important thing I will like to I would want you to pay attention to always when this is a cash outflow. So I'm going to put a negative sign, and this will help you. This way this practice will actually help you when you will be using calculator. So this is an outflow, cash outflow, and this is an actually an inflow. So I'm assuming that this is an actually an inflow. So I'm putting a positive here. So you there was a $900 outflow and there's an inflow of $990. After 1 year, 0 and 1. You actually have to tell the calculator. The negative means the calculator doesn't have. It's not that advanced. That's why it's allowed in the exams. So you actually have to tell the calculator this is a cash outflow and this is a cash inflow. So for that, use negative and positive numbers. And uh, just pay attention to this is important. If you do not pay, if you don't use the negative and positive signs, the calculator is going to assume that everything is a cash inflow. uh, or if you put negative signs across, so the calculator will assume that these are all cash outflows, and your values, the calculations will not be able to give you the right picture or the right answer. So pay attention to this thing always. When you're calculating using the calculator, always put in the positive and negative signs. We will talk about the calculator, how the calculator functions in later part, because as of now it's not required right now. So okay, so let's get back to our example. So here, this if you are lending somebody $900 and you are receiving $990 after 1 year. So this is how we are going to interpret the interest rate. This is what we are going to make about how the interest rate. The interest rate, if we think about the interest rate in this situation, in this example, I have given you 900, I have given you 900 and you have returned me 990. So here, if you calculate this thing, so there is a 10% interest rate. So this is the required rate of return. Let's talk about the required rate of return. So this is the fact that you are willing to give me 900 today, and on the condition that you will get 990 after 1 year. Then this uh, means that to engage in this transaction, you require a return of 10%. And uh, simple calculation will show you that the interest rate in this transaction is 10%. We have calculated this thing. Simple calculation. We have in our elementary schools, we have done the formula. So future value is equals to present value 1 plus r to the power t. This was the formula we learned in our elementary schools. Now pay attention to this thing. Future value is going to be more here, and present value is going to be less. This is a one case scenario. This could be wrong, this could be different, but that's compounding and discounting. That's what if you think that there could be multiple scenarios, then yes, that's compounding and discounting. Here we are talking about compounding, not discounting. So future value uh, is going to be more than the present value. And if you look at the formula, observe carefully, we are multiplying the present value with something here. If we use 900 and multiply it with 1.1, this is going to give us the 990. And this is what actually the situation, the formula makes out of. So 1.1, I am multiplying with 900. This is going to give me 990. This is just simple. This is pure mathematics. In a very, I mean, this is the simplest way to explain this formula. I am multiplying it with something and to the power p, and here it's only 1. So the calculation is also simple. So 900 into 1.1 is going to give me 990. So that's the required rate of return. If I were to give you that, if I were to give you 950 dollars at the end of 1 year, maybe you would have not engaged in this transaction with me. And this is actually the required rate of return. So this is the fact that you're willing to give me 900 today. And the condition is that I'm giving you a 10% return. Then only you are engaging in this transaction with me. So that's the required rate of return. The required rate of return in itself, this is the required rate. If I'm giving you any rate below this, you will not engage in this transaction with me. And then comes the discount rate. So discount rate is somewhat similar to the required rate of return also. So you can discount the money that you will receive after 1 year. uh, so you can discount this money. If I am calculating from the future value, the present value, this is discounting. And if I am using the current value and calculating the future value, that's compounding. Compounding and discounting. So in discounting, I am looking at the present value. So I am calculating the present value. I'm discounting it. Okay, it's all gone now. So discounting, we are calculating the present value, and when we are talking about the compounding, we are calculating the future value. Just remember this thing, the meaning of compounding and discounting, and you can move around this formula, do a little reverse engineering, and you can find that present value is equals to future value when we divide it by 1 plus rate to the power times t. So this means that rate is going to be having, there is going to be a multiplier effect because uh, here this is actually simple example. This is just one year example. So if there are multiple periods, multiple years, let's assume that okay, we will do that in next example. So I hope this much is clear to you. So when we are from future value, we are calculating the present value. The how much do we have to invest right now? How much do we have to invest right now? How much, these kind of questions. So how much we invest right now. So that's actually discounting. We are discounting things. We are at time zero. We are bringing every calculation to back to time zero, and that's discounting. And when we talk about that, how much we will get after 1 year if we invest at this rate, and this much is the capital we are investing, and how much in how over the time horizon of multiple years or 1 year. So this much, so that's the case where we are discussing about the compounding. We are compounding it. So when we are talking about the future, just remember this thing: compounding and discounting. It will help you. It will help you when you will be working on multiple, tricky questions. It will be really helpful when you will talk about annuity and perpetuity, annuity, perpetuity, or college funds or pension funds or provident funds or multiple scenarios. There could be multiple uses of these things, but these are the compounding and the discounting are the element, the basics, the basic building blocks. If your basics are not if your basics are weak, then you will not be able to the advanced level calculations, you will not be able to do that comfortably. So yes, you will be able to mug up things, but you will not be able to understand the concept. In level 1, yes, you will be able to clear that, but in level 2 and level 3, you will not have time enough time to understand these concepts back. uh, okay, so that's pretty much it. So we have talked about the required rate of return. We have talked about the discount rate, and one thing, opportunity cost. So let's talk about opportunity cost for a little moment. I mean, the definition of opportunity cost is that. So okay, so you have invested this $900 to get $990 after 1 year. So opportunity cost, instead of landing $900, you spent, if you could spend it on something else. So, and if you wanted to spend your $900 on something else, but you have actually foregone that opportunity, and you have foregone that opportunity to earn a 10% interest on your investment. So $900 negative and 990 positive. So opportunity cost, you might have a better use of this $900. If you don't have, if you had, so you have actually that opportunity, you have foregone or let go of. So, and you have invested this money at a 10% interest rate, and you have received 990 after 1 year. So this 10% can also be thought as an opportunity cost, but opportunity cost concept is different. Let's think about that. You actually wanted to go on a trip. You did not went out to the trip, so you were planning a trip. You were planning to do some shopping. You were planning to invest, not invest, but you actually have invested here. You were planning to buy something, a new phone maybe. You were planning to invest in a friend's business. You were planning to buy a vehicle, maybe vehicle. If you can buy a vehicle at $900 for $900, or maybe you wanted to do some update yourself, go and do some course or some degree diploma, but you actually forego of all these opportunities and you invested this money. So this the concept, the definition of opportunity cost is this is the opportunity cost which you have uh, forego of. So you have let go of all these dreams of yours. You have delayed gratification here. You have shown delayed gratification here, and you now have 990. Maybe at after 1 year, you have better use of this $900. So that's the opportunity cost, the concept of opportunity cost. So whenever you come across this definition, always think about opportunity cost as something that you have forego of. Now let's talk about the determinants of interest rates. So we have talked about, as of now, we have talked about discount rates, we have talked about opportunity cost, we have talked about required rate of return. The required rate of return, the rate of return that an investment should be giving you to get yourself engaged into that transaction. Uh, Less than that, you will not engage yourself. And required rate of return, that will be helpful when we will talk about internal IRR and NPV. So that's required rate of return. How it will be useful for when we talk about corporate issuance or in the further readings, how it will be helpful to understand that. See, let me give you just a quick overview. When we calculate about internal rate of return, so if there are multiple investment, one investment is giving 10%, 12%, and 15%. Uh, our break even of IRR, internal rate of return, which investment we will prefer here? We can prefer multiple investments, and we can prefer one single investment. But the net present value factor also comes into play. So there we actually require there we will be using the required rate of return concept. Uh, we discussed about money today or money after 1 year. So something today or something after 1 year. And this is used in cash flows also when we look at investments. So there it will be used required rate of return. The required rate of return, which investment we does 15% looks lucrative, or does the 12% has lesser risk? These are the questions we will be answering, not the lucrative one, but maybe we will be preferring the investment where the interest rate is lesser. So these kind of questions will be we will be encountering these kind of questions when we will move a little further. And this is the like I told you, this is the basic building block of your CFA to quantitative aptitude and FSA. These are the basic building blocks, and you will be using these concepts across. And by the end of everything, you will be able to connect all the dots. And this is what actually the purpose of this. I mean, this is actually the purpose of all these subjects which we will be reading, and that's why the syllabus is very lengthy. Okay. So now I hope you have understood what discount rate and opportunity cost means. Verbally, you have there should be a verbal clarity. There, the required rate of return we have discussed, and now let's understand what does I mean that interest rate is composed of. We have talked about 10% interest rate, but what does this 10% interest rate composed of? What are the components of 10% interest rate? So when we talk about interest rate, uh, so there is a risk-free rate, inflation premium, default risk premium, liquidity premium, and maturity premium. This is what actually makes an interest rate. So risks, when we talk about the risk-free rate, so this is the rate that you get on a security that has no risk and is extremely liquid. So we make an assumption here that there is no inflation. And majorly, when we talk about risk-free rate, these are the government treasury bonds, 10-year treasury bonds, so long-term treasury bonds. And government usually doesn't default um, unless until there are situations. But governments always have an option to print the money. So government usually do not default, but there are going to be negative impacts of quantitative easing and then afterwards quantitative easing and quantitative tightening. If you want to learn about these things, you can learn. Let's not discuss about them right now. So government 10-year bond, those are risk-free rate. I mean, that's the real risk-free rate. Then we add in the inflation premium. So inflation means that inflation premium is expected annual inflation in the upcoming periods. So inflation in layman's terms, it's that if something is worth today $100 or $10, maybe some any appliance or anything, next year it's not going to be $10 because of inflation. Because of inflation, it's going to be $12. So that's inflation because the raw material is going to increase. The cost of raw material for the producer is going to increase. And because there is going to be higher demand next year, the demand will go high, and this will drive our cost, the raw material, the cost. So this will drive a companies also have target to generate higher revenue next year. So this is how actually everything is linked, and we will talk about these things when we will discuss about economics. So we will discuss about the market equilibriums, oligopoly is there, perfect competition, oligopoly, monopoly, monopolistic competition. We will discuss about these in economics. I would recommend you not to register for CFA exam unless until you have gone through the syllabus once. Then only see if CFA is something that if you are able to commit yourself to CFA. So everything will link when we will be when once we will complete syllabus once. So we will be able to complete the syllabus once, and then you will be able to link everything back to the basics. And one more times you will when the next time you will start to do your revision, then you will be able to connect everything. So inflation, this is what actually drives the inflation. Uh, then we talk about a default risk premium. So uh, you, I mean, when we add the default risk premium, this is actually an additional premium that investors require because of the risk of default. So let's say that you lend some $100 to somebody. Let's say $100 to somebody who has actually a high risk of default, and you are worried that he might not pay. So there is this person A and there is this person B. So $100 you have given to both of them $100, and this person A actually has high default. So previously also there is a history that uh, he has defaulted uh, with payments. So this could be your friend, or this could be your brother, this could be your relatives. So, so if you think about it, it's a bad investment advice to give. I mean, this would be a bad investment choice to give lend money to your friends, brother, friends and family. Uh, and another situation is here where a person who actually has a very good credit score, and they have paid previously. They actually have paid uh, all the all the payments on time. They have made all the payments on time. So this is what default risk means. So the probability of default, probability and possibility of default here is high, and the possibility or probability of default here is low. So this is going to be add a premium into the. So this will actually, this default risk premium is going to be a certain percentage rate. For high default, there is going to be a high premium, and for low default, maybe there is a low premium, lesser premium for low default person. Or it's very rare that we use zeros when we talk about default risk premium, because there is always risk. I hope you have understood what default risk premium means. And now let's talk about equity. Oh, sorry, liquidity premium. So liquidity premium compensates the investor for the risk of receiving less than the fair value for the investment, and it must be covered when we are converting it into cash quickly. So liquidity means that we are able to how quickly we are converting the asset or the investment into cash. So if you say that you have bought a house for maybe $100,000, and you have bought uh, stocks for a company for $100,000. $100,000, you have bought 100,000 stocks. 100,000 stocks, $1 per stock. So if you want to convert this asset, this investment into cash quickly, so this is going to take time. But if you want to convert this asset into cash quickly, so you will be able to sell your investment right in the market, and you will be able to convert it into cash. So that's what liquidity is referring to here. So how quickly could you quickly could you convert your investment into cash? So that's liquidity. And I hope this is clear. But one more component we have left is maturity premium, and we are running short on time. So maturity premium, when we talk about maturity premium, so maturity premium is the premium that investor demand on the security with long-term maturity. And the maturity premium compensate investors for the increased sensitivity of the market value of a debt or an equity investment to the change in the market interest rate as maturity is extended. And understand this thing, we will learn about maturity premium in fixed income investments. Fixed income investments. Okay, so market conditions keep on fluctuating. The interest rates keep on fluctuating. If you have started your investment at a higher rate, if you have invested at a higher rate, here the rate is high, the rates are going low, the rate are low, and the rates are high again. So let's take this situation only. Here the rates are high, and here the rates are low. So if you have taken loan from the bank at this time, here the 10% interest rate, here the interest rate has fallen to 5%, and this is very rare situation, and this is a hypothetical example. This won't happen. The interest rates are not going to fall by 5%, but just an hypothetical example so that you get a clarity about what we are talking about. So 10% interest rate and 5% interest rate. If you have taken a loan here at 10% interest rate, and once the interest rate falls, so you will want to pay off your loan and take a loan at a lower interest rate. And if you are investor, if you have invested into something here, if you are an investor from a investor's perspective, if you have invested here and the investment is falling down, the interest rate is falling down, so your investment is falling down here, the return on the investment is also falling down. So what you would also want is you would want to pay off your, take out your money. At this investment, you actually have to track the interest rates. So this is what actually the maturity premium means, because when you invest into something, there is a lock-in period also. Lock-in periods are there. The longer is the time horizon. So there are the risk actually increases. So maturity, let's say that there is an investment of E and F. So this actually has a maturity of 1 year. So the investment E has a maturity of 1 year, and investment F actually has a maturity of 4 years. So because of longer maturity, F is more sensitive to risk, and I mean the the price being sensitive to the change in interest rate. So your long-term investment actually has a interest rate sensitivity to the market. So you will understand this concept better when you study the fixed income securities, and but for now you can take it as given. So understand why the F actually has a higher maturity premium. And when we talk about the nominal interest rate here, the okay, we have not discussed this thing. Nominal interest rate. So nominal, the difference between nominal interest rate and the risk-free interest rate, which is also known as the real risk-free rate. This concept is important, and this actually is the foundation for tricky questions when we talk about the rates and return. Understand this thing. When we talk about an interest rate, if the inflation premium is added into the interest rate, it will make the nominal risk-free rate. And when we talk about the real risk-free rate, it does not include inflation. So something you need to pay attention to. These two components of the interest rate, this makes nominal risk-free rate. And if you encounter any question where they have actually given you the nominal risk-free rate, carefully understand this thing, that then the inflation, they have actually factored in the inflation premium in that interest rate. So nominal risk-free rate actually have interest rate in themselves. And the risk-free rate of interest, uh, it's a theoretical rate of single period loan that contain no expected inflation and zero probability of default. That's why government bonds. Okay, so one more thing, it represents in the economic terms as a time preference, the degree to which current consumption is preferred to equal future consumption. So this means the risk-free rate. If I am giving you $100, if you are investing $100 today, and at the time one after 1 year, because of inflation, uh, if I'm giving you $110, so this means there is a lot of the purchasing power of money is same here. So this you need to understand when you are talking about this the rates. Now let's do quick question, so that you get a better understanding of what we have discussed as of now. So this is an example where we are talking about the investment, the maturity, liquidity, default risk, and interest rate. So uh, there are five investments: A, B, C, D, and E. Maturity in years is 1, 2, 3, 4, and 5. Here the maturity is increasing. The maturity premium will increase. The liquidity is high. Here the liquidity is high. The low, here the liquidity is low. Here is the liquidity is high, and here the liquidity is low. So there is going to be a high liquidity premium. So there, because the liquidity is low here. So here the premium is going to be high because of low liquidity. Okay, let me just do one thing. And when we talk about default risk, this actually has the highest default risk. So now let's factor in these things. So as we move down, the maturity premium increases. There is going to be maturity premium, increase in maturity premium. When we go, when we look at the liquidity, because of the high liquidity, the liquidity premium is going to be low, and because of low liquidity, the liquidity premium is going to be high. And this 2% is calculated based on these factors: low maturity, high liquidity, and low default risk. So if these are the best conditions, and this is going to give us 2% of interest rate. Okay, let's do. Okay, so this is going to give us 2% of interest rate. When we talk about the other conditions, other investments, uh, with 2 years of maturity, liquidity is low here, and this is going to increase our, so low default risk, it's okay, but the liquidity low and high maturity is something which has increased our investment from 2 to 2.5.